You signed a mortgage. You got a rate. You thought the rate was based on your credit score, your income, and whatever the Fed was doing that month. That is what everyone thinks. But there was a third factor in that room that nobody introduced. Nobody mentioned it. It does not show up on any closing document. And for 30 years, it quietly made your borrowing cheaper. That factor was not your bank. It was not your broker. It was a central bank in Tokyo. And right now, it is leaving the room. My name is Jordan. And once you start looking at how global money actually moves, you realize that your mortgage rate has always been connected to decisions made on the other side of the world. There is a hidden funding loop that ran quietly for decades, held your borrowing costs lower than they should have been, and right now that loop is snapping. When it fully snaps, the cost lands on you. Let me show you exactly how this worked, and more importantly, why nobody explained it until the bill arrived. For roughly 30 years, the Bank of Japan, Japan's central bank, kept its interest rates near zero. Not low, near zero. Basically free money. Japanese banks, insurance companies, pension funds, and global investors looked at that and asked a very reasonable question. Why would we park money in Japan earning almost nothing when we can borrow in yen, convert it to dollars, and buy American government bonds paying real returns? So that is exactly what they did, for decades. Let me put this in terms that make sense at the kitchen table. Imagine you have a neighbor with almost unlimited access to nearly free money. Instead of doing something reasonable with it, they decided to lend it across the ocean to earn a better return. And the side effect of that decision was that your mortgage rate quietly got cheaper. You never met this neighbor. You never thanked them. You just noticed your rate was lower than your parents paid in the 90s and assumed you were just better at adulting. You are not. You had an invisible subsidy. This is called the yen carry trade, and it became one of the largest invisible financial flows on the planet. Institutions borrowed in yen because it was nearly free, converted that money into dollars, and flooded into U.S. Treasury bonds. That flood of demand for U.S. debt quietly pushed American interest rates lower than they would have been otherwise. Not because anyone in Washington planned it, not because any American politician made a deal. It happened because Japanese money was chasing better returns, and the side effect was cheaper borrowing for everyone in America. Your mortgage rate was lower because of a decision made in Tokyo. And here's where this gets strange. Japan, through its government, banks, insurers, and pension funds, accumulated roughly $1.2 trillion in U.S. Treasury holdings. Analysts estimate that the flow of that capital helped suppress long-term American interest rates by somewhere between 1/10 and 0.5 percentage point over time. That might sound small, but on a 30-year mortgage, 0.5 point is not small. It's tens of thousands of dollars. You were getting a discount, and you did not know it existed. Think about the last time you refinanced or bought a home. You sat across from someone at a title company. They slid a paper across the table. You looked at the rate, maybe winced a little, maybe felt okay about it, signed and moved on. What you did not know was that sitting somewhere behind that rate, invisible and completely unannounced, was over $1 trillion of Japanese institutional money, quietly making that number smaller than it would have been otherwise. You just thought you had good timing. Here's the analogy that makes this click. Imagine you're buying a house. The bank looks at you, looks at your income, and gives you a rate. Now imagine a wealthy neighbor quietly walks in, co-signs the mortgage, and the bank suddenly feels better about the whole deal and drops your rate. You never saw the neighbor. You never knew they were there, but their presence made your payment cheaper. That neighbor was Japan's central bank and its investors. And now they're walking out the door. But the real problem starts here. The Bank of Japan has been slowly, carefully raising its own interest rates. Japanese bond yields, which were suppressed for decades, are starting to rise. And when Japanese investors can earn meaningful returns at home in their own currency with no currency risk, the math changes. Why take on the complexity of borrowing in yen, converting to dollars, managing exchange rate exposure, and buying US bonds when you can just invest at home? The answer is you probably would not, and they probably won't. And look, I want to be fair to Japanese pension funds here. They were not thinking about your car payment. They were trying to earn enough return to pay retired Japanese workers. They just happened to do it in a way that accidentally helped you finance a truck you probably didn't need. Now they're bringing the money home, and that truck payment is getting more expensive, which tracks. As that capital starts flowing back toward Japan, demand for U.S. Treasuries quietly drops. And when demand drops, the U.S. government has to offer higher yields to attract new buyers. Higher yields on Treasury bonds mean higher rates, rippling out through the entire borrowing system: mortgages, auto loans, credit cards, business loans. The system is repricing, and most people watching their rates climb have no idea this is part of the reason. Now think about how this hits a real family. Your income didn't change. Your credit score didn't change. The value of your home didn't change. But your mortgage rate is higher, your car loan is more expensive, and your 401k is more volatile because institutions that used to flood into U.S. assets are slowly redirecting their money. You are absorbing the cost of a global capital shift you were never told was happening. That's not bad luck. That's the hidden mechanic becoming visible. Now here's the part that should make you pause for a second. Nobody in this story was trying to help you. That is not cynicism, that is just how the system works. The Bank of Japan was managing its own massive government debt load and trying to keep its economy from deflating. Japanese pension funds were trying to generate returns for their own retirees. Hedge funds were running leveraged carry trades to extract profit from the rate differential. Your lower mortgage rate was a side effect, a consequence of other people's incentives colliding in a way that happened to benefit you. The system was not designed to help American households. It just accidentally did. And now that the accident is over, the system is not designed to protect you from what comes next either. That is the part worth sitting with. The bank did not raise your rate. The world just stopped quietly lowering it for you. There is a difference, and the difference is everything. Nobody took something from you, they just stopped giving you something you never knew you had. That is how most financial shifts work. The subsidy disappears silently. The bill arrives loud. So what does understanding this actually do for you? It does not change your rate today, but it changes how you think about financial decisions going forward. If long-term U.S. rates face structural upward pressure as Japanese capital repatriates, then the era of assuming rates will quickly return to where they were may not be realistic. Locking in fixed rates where possible, being cautious about variable rate exposure, and thinking carefully about timing on major financial commitments all become more important when you understand the global dynamics underneath the numbers. The carry trade was never your friend. It was just accidentally pointed in your direction. And when it turns, it is not pointed at you on purpose either. You were just in the way of where the money used to go. The financial system is not just domestic. It never was. Your mortgage rate has always been connected to decisions made in central banks across the world, to capital flows you could not see, to incentives that had nothing to do with your creditworthiness. Most people only see the rate. They never see the machinery behind it. Japan's central bank quietly co-signed American debt for 30 years. The rates you paid, the houses you bought, the cars you financed, the credit you accessed, all of it was priced in a world where that invisible support existed. That world is shifting. And the shift means that understanding global capital mechanics is no longer just for financial professionals. It is something every household should start paying attention to.
because the system does not wait for you to understand it before it sends you the bill.